Welcome to Property Focus. I'm Kate Miller. Making headlines this week, growing uncertainty in the international economy increases the prospects of an interest rate cut, and regional centres are earmarked as the next best investments. But first, our lead story. As economic concerns continue to unfold across the globe, investors can be safe in the knowledge that interest rates are unlikely to move upwards anytime soon. AMP Chief Economist Shane Oliver told Property Focus that international uncertainty is likely to lessen the Reserve Bank's penchant for tighter monetary policy.
Going forward, we think that the most likely scenario is that for the next few months anyway, rates will be on hold, possibly into early 2012, and that's against a backdrop of continuing inflation concerns on the part of the Reserve Bank, the mining boom, so they're both pointing to rate hikes. Against that, though, uncertainty regarding global growth and weakness domestically. So rates on hold for an extended period and going through into 2012, I think the case is actually building for a rate cut.
Granny flats are proving an ideal way for property investors to strengthen their cash flow, according to Property Secrets Director Paul Giezekamp.
Basically, it's a really good strategy to get dual incomes, two rental incomes, one loan repayment. What that is going to equal for you is being positive cash flow at worst, and then at best positive geared, which is very rare to find in Sydney, if not impossible.
The addition of a granny flat can be a great way for investors to get a feel for property development as well as generate easy returns, Mr. Giezekamp said.
It just means that for people that are thinking of getting into developing and they want to put the little pinky into the water and to see how it goes, it's a very cheap way of learning how to develop and seeing the benefits. You know, if you have a look at it pound for pound, like what they talk about in boxing, granny flats are a great way to actually get in there and get the returns without having all the risk. If you think about $70,000 at 7% interest rate, that's about $5,000 a year in repayments interest only. You could guarantee that by fixing it for 3 years at 6.99. I think St George's got a great rate at the moment. And then the actual rent from that granny flat is $250, which is $13,000. You're $8,100 in front per year without a job or without a tax check.
Investors should turn their eyes away from over-milked capital cities towards the nation's regional markets, according to Destiny Financial founder Margaret Lomas.
Once you understand that as a country we are no longer city-centric, we don't have to live in the cities anymore. Technology lets us live anywhere. Blue-collar workers are moving out of town because the large industries are moving out of town. White-collar workers are moving out of town because technology allows us to do business from anywhere in the country. And that means we're going to see a lot of pressure being brought to bear in the big regional markets of Australia. They're the areas to be buying now.
And the September issue of Smart Property Investment magazine is on its way to news agencies across Australia, arming investors with the key strategies needed to find the nation's burgeoning hotspots. In our September cover story, we show you how you can find locations with the best prospects for growth that are going to deliver you the best returns. Also, 31-year-old Mani Kaur reveals how she's purchased 10 investment properties in just 15 months, and we show you how you can wipe $25,000 off your mortgage fast. All of this and a whole lot more in the September issue of Smart Property Investment on newsstands next week. And that's it for Property Focus for this week. I'm Kate Miller. See you soon.